When HM Revenue and Customs opens an investigation into a small business, they are not selecting targets at random. They operate a highly sensitive digital targeting system that continuously scans for anomalies. The agency no longer relies on human auditors picking files off a desk. Instead, HMRC deploys powerful algorithmic data matching engines designed to detect statistical inconsistencies across millions of tax submissions simultaneously. According to the 2026 UK SME Tax Compliance Framework, investigations are triggered almost exclusively by conflicting data within a business's own filing architecture. If your numbers disagree with each other, the system automatically flags your profile for review. Please note that this breakdown is for educational purposes only and does not replace professional tax, legal, or financial advice. This diagram illustrates a standard business filing architecture. The central SME node continuously feeds clean data lines into three primary concurrent receiver streams: your VAT returns, your corporation tax returns, and your PAYE submissions. Today, we will deconstruct the 11 primary risk vectors that trigger algorithmic flags. We will track exactly how a single mathematical mismatch can lead to a structural review of the entire business operation. By understanding the logic of this matrix, tax compliance moves from an exercise in guesswork to a process of deliberate data alignment. The most common trigger in the entire HMRC system is inconsistent income reporting across concurrent filings. This split-screen ledger demonstrates how the algorithm cross-references different tax returns to find mathematical gaps. On the left, VAT returns sum up to £400,000 in turnover. On the right, the corporation tax return claims £500,000. The system zeroes in on the unexplained £100,000 difference, flattening the account for human review. Perfectly matched numerical data across ledgers will still fail if it lacks an evidentiary baseline. The math must be proven. When a business cannot provide basic documentation, such as purchase invoices, mileage logs, receipts, or clear bank statements, the reliability score of the entire tax return drops immediately. In the absence of those records, the algorithm defaults to the assumption that the claimed expenses lack a genuine business purpose, shifting the burden of proof heavily onto the business owner. Cash-heavy businesses carry specific elevated vulnerabilities to these evidentiary gaps because physical currency is inherently harder to trace. Missing till records, unrecorded cash sales, or bank deposits that come in lower than the expected sales volume force HMRC into a position where they must mathematically estimate the business's actual income. When HMRC must build an income estimate based on incomplete records, control of the data narrative shifts entirely away from the business and into the hands of the tax authority. A single numerical mismatch or a missing receipt acts as a foundational crack in the data architecture, practically inviting the algorithm to search deeper into the company's ledger. The algorithms do not stop at pure mathematical errors. They also actively track operational and behavioral patterns to assign continuous risk scores. This timeline illustrates a high-risk operational pattern. It tracks erratic, sharp spikes of late VAT and PAYE filings alongside a cluster of repeated last-minute amended returns. The system reads this specific cluster of behavior as a digital signal of systemic, weak internal controls. Once the system flags operational weakness, it applies a secondary layer of scrutiny, called sector benchmarking. This chart visualizes how HMRC compares your claimed expenses against an industry average. A horizontal baseline establishes the sector norm, while vertical bars represent your specific claims. The algorithm immediately flags any bar breaking above the threshold. The highest risk outlier categories consistently fall into three areas: home office costs, motor expenses, and client entertainment. Severe red flags are triggered when algorithms detect personal items masked as business costs, or a suspicious pattern of consistently filing perfectly round number expenses. Fuel claims submitted without corresponding detailed mileage records act as an automatic algorithmic tripwire, guaranteeing closer inspection. The system continuously evaluates the behavioral profile of your business against thousands of your peers, automatically penalizing any operational or statistical outliers. That remains the most sensitive and frequently tripped wire in the entire HMRC compliance matrix. The fastest ways to trigger a VAT audit involve incorrect use of the flat rate scheme, input and output miscalculations, or confusion between exempt and zero-rated supplies. Beyond VAT, the matrix contains subjective tax reliefs. Because these rely on interpretation, they require rigorous qualitative proof rather than simple quantitative matching. This network map isolates the highest-risk complex relief nodes in the tax system, IR35, research and development, and transfer pricing. The system monitors R&D claims for weak technical justifications, routine work disguised as innovation, or heavily overstated staff time. Under IR35, the system scans for businesses treating workers as self-employed when they lack genuine operational independence. Transfer pricing draws scrutiny when HMRC detects artificial pricing structures in related party loans or excessive management charges moving between connected businesses. Errors in these complex nodes rarely stay contained. They trigger what HMRC specialists call a compliance chain reaction, expanding the scope of an initial investigation. This visual demonstrates how an investigation spreads from a localized point into entirely different tax domains. A single pulse starts at a red VAT error node, traveling down the connection to infect the rest of the network. The mechanism is direct. An unresolved VAT inconsistency gives HMRC the legal and statistical justification to examine the business owners directly, leading straight to an audit of overdrawn directors' loan accounts. That localized audit then expands to uncover unreported P11D benefits, and finally subjects past R&D claims to intense forensic review, turning a single error into a system-wide critical alert. Because the data matrix is interconnected, a localized error functions as an entry point. Once a mismatch is identified, the system has the statistical justification to cross-reference and verify other nodes in the business structure. Navigating the 2026 UK SME tax landscape relies on engineering robust, internally consistent data systems rather than reacting to audits after they occur. In this compliant architecture, nodes for VAT, corporation tax, PAYE, and directors' loans align symmetrically. Data flows smoothly. Contemporaneous documentation, invoices, logs, contracts, provides an evidentiary shield. Exact numerical alignment across all channels defends against automated risk scoring, locking into a secure state. Engaging professional counsel early is essential when handling high-scrutiny domains like R&D credits or contractor employment status, where the definitions require expert qualitative assessment. The most effective action a business owner can take today is to review and tighten internal controls, ensuring that all records are complete and mathematically balanced prior to filing. Modern tax compliance is an equation. The safest businesses are those that ensure the math balances perfectly before the algorithm even looks.